In today's episode, we are going to talk about how to build a 400 unit real estate portfolio. Yes, you heard it right. 400 units with no syndications. To help us with that, we have James Gleason. He's a real estate investor, author, and mentor based out of St. Louis, Missouri. We're going to talk about why go JV versus a syndication. We're also going to talk about why JV versus just borrowing the money like from private lenders as well too. And then we're going to go over basically like if we were a student, how to build up a 400 unit portfolio. Welcome to the podcast, James. How are you?
Pleasure. Thanks for having me. I'm good. How are you?
Excited, man. Excited to do this. So let's start off with how does somebody go about building a 400 unit portfolio? Like meaning like how does that start? Like were you gifted a bunch of money or where did that come from?
Certainly not. I mean, plain and simple, it's one property at a time, right? I always tell people you probably don't want to start with the larger apartment units because if you make a multi-million-dollar mistake, it's probably irreversible. So, But if you make a mistake with a single family or a small multifamily or something like that, you can sort of learn from those mistakes. So I got started about 7.5 years ago. Bought a single family home just off of Craigslist. Bought that for $25,000 in 2018. That house today is worth about $160,000, and just bought that with a private money lender. Didn't know anything about construction. Didn't know really hardly anything about real estate. But I was reading all the books, I was listening to all the podcasts, and I just took a ready, shoot, aim approach and kind of learned as I went. And, fast forward 7.5 years later, I mean, I've had contractors steal from me. I've had way too many, projects go over budget. I've had projects that take well over 12 months. I bought a 17 unit apartment complex that almost made me go bankrupt. And I've put literal blood, sweat, and tears into this business for 7.5 years. So I didn't just quantum leap into, 430 units. I took it one house at a time. That led to a duplex, that led to a quadplex, and then I started buying larger deals from there.
I love it. What did you do as a living before buying your first property or during, or did you become a real estate investor just full-time, or did you have a full-time job at that time?
No, I absolutely had a full-time job, and I don't recommend people just dive into real estate investing. I think one of the biggest myths from TikTok and Instagram and all these things is, you see a lot of people say that you could get into real estate without using any of your own money. And that's true. You absolutely can. I've done it several times. But if you ignore your income, you're making a massive mistake. I always tell people your income is going to be incredibly important for your growth as a real estate investor. Because when you get into projects, these projects will go over budget. A lot of these projects, you will buy bad deals. You will get into deals that take more money than you think. And then the other thing, even if you're using hard money or private money or creative finance, like you're going to find yourself putting $10,000 into this deal, $15,000 into that deal, $5,000 into that deal. So if you don't focus on your income, I mean, you're eventually going to run out of deals, especially if you don't have anyone to partner with when you're just getting started out and you're just, trying to build a track record. So I absolutely encourage people to work a full-time job. So I was a full-time engineer. I went to school here at Rolla, University of Science and Technology. It was very, very difficult. It was a blessing in disguise for me because I learned what I didn't want to do. I Googled before I went to Missouri S&T what undergrad degree makes the most money. And engineering came up, and that was my criteria. So I went with it. And fast forward, I learned that was not a good reason to get into a career. And then I discovered real estate investing when I was in university. And I was an engineer for roughly 5 years. But the entire time, I had that vision in mind that, I was doing real estate investing on the side. And so I was a full-time engineer. I was a server on nights and weekends working at restaurants. And then, everything in between, I was painting my own properties, laying flooring in my own properties. So kind of a long-winded answer, but I just want to get across, I was extremely active, not only in my full-time job, but also as a real estate investor to really make it to this level.
I love it. It's funny because I heard this analogy about fast money, medium money, and slow money.
Yes.
And having that fast money, meaning like your job, something that is that consistent source to be able to dump into like the slow money, which in some cases is the rental properties. Now, as a real estate investor, do you also flip properties or do you mainly buy and hold? And what are your thought processes on either one of those and why?
So the vast majority of what I do are rental properties. I do have a handful of flips. To your point, even as a financially free full-time real estate investor, fast money and long money are still incredibly important to me, right? It's pretty rare that you're going to find a full-time real estate investor who just sits back and collects his cash flow. So for me, I really have three main businesses. I have my construction company, and I created my construction company to become vertically integrated, because I had just gotten screwed over with so many construction projects. So I started my construction company. It's called Checkout Construction. And now everything that I do from a construction perspective is in-house. My second business is Multifamily Methods. That's my education business. That's where I teach other people to do exactly what I did. And I've helped dozens and dozens of students, build a portfolio in real estate investing. And then I'm also doing a handful of flips, and then I have my rental portfolio. So the fast money or the short-term money is still very important to me, right? That's what I live off of. I use that to reinvest into real estate. I have a goal to pay off my primary residence this year. Be happy to talk about my logic behind that. So income is still something that I'm very, very intentional about, even though I have 400 units and I've created financial freedom. But no, flips are great. I mean, you can make a lot of money doing flips. Flips are exponentially more difficult than rentals. From a tax perspective, they're less advantageous. You have to be very detail oriented. The house has to be perfect. It has to look like the Taj Mahal. Whereas with rental properties, not that you want to put lipstick on a pig, but you don't have to be quite as detail oriented. So if you're going to get into flips, it's going to be probably a lot more difficult than you think if you've watched HGTV. But I always recommend, if you don't have a high income skill, I think flips are a great way to do that. But you have to focus on your income.
I love it. So let's say somebody wants to build a rental portfolio. What is the formula to build a large rental portfolio?
So this is kind of a broad question, but I'll kind of take it one step at a time. So I think from the very beginning, you have to focus on your short money and your long money. So I don't recommend, there's some influencers out there who say, don't invest in real estate until you're making at least $250,000 per year. I don't necessarily subscribe to that. I think you can do both. So I think you can, work your full-time job, focus on your active income, or do a side hustle. Maybe that's fix and flips, or maybe that's something else. And then simultaneously purchase your rental properties one property at a time. If you're newer to real estate, I would ignore all of the strategies out there and I would laser focus on the BRRRR method. Because the BRRRR method is really the only strategy in real estate where you can quantum leap your net worth property after property. So if you seller finance and you get a seller to agree to finance 100% of the deal, that's great. And congratulations, you bought a deal with no money down, but you now have $0 of equity or very little equity. If you do a subject to deal, in a lot of cases, you could be upside down on your equity. So really the BRRRR method is the only method. I buy duplexes and quadplexes all the time, and it's like $80,000 of equity here, $120,000 of equity there. If it's an apartment complex, I might have $1 million of equity in one deal because it's a value add deal. So I'd say step number one, focus on your short money and your long money. Step number 2, laser focus on the BRRRR method and ignore everything else. Step number 3 is obsess with operations. This is one of the biggest mistakes that I made as a real estate investor. And what I mean by that is the highest dollar per hour activity as a real estate investor is finding deals and finding money. That's where you're going to create a net worth. But as a result of that, people ignore the operations, which is the construction management and the property management. Once I mastered the construction management and the property management, finding the deals and finding the money became exponentially easier because now people wanted to partner with me and opportunities started to present themselves. So now in St. Louis, I might be a little biased. I think I have the best system for construction management in St. Louis. I have the same flooring, the same paint, the same kitchens, the same baths, and I'm doing 15 to 20 projects per month on this conveyor belt because I've really mastered the operations of this business, the construction management and the property management. And it's the same thing with the property management. I used to hire third-party property management. I went through about 10 plus companies in St. Louis, and they were making all the profit and I was making nothing. And so I started an in-house property management company as well, and we're kicking butt at that too. So now that I really know how to manage the construction of a deal and manage the tenants and the property, success is inevitable once I find a good deal and find the money. And now doing both of those things is a lot easier. So I would say that's step number 3. Put a lot of focus into your operations. And then step number 4, I would say I did not get the shiny penny syndrome. So to this day, all I do is residential real estate in St. Louis. And I'm very, very good at residential real estate in St. Louis. I've never bought a mobile home park. I've never bought self-storage. I've never done commercial buildings. I've never done any of those things. I have only done 1 to 4 units, and then I've only done apartment buildings in residential. And I'm at a point in my business now where I've done that so many times that it's starting to become boring. Like I wake up every day and I'm doing the exact same thing that I was doing several years ago. But because it's boring, I know that I'm on to something.
Yeah.
I'm just doubling down doing the exact same thing every single day. And I'm growing my portfolio by a dozen plus units every single week because I'm doing the exact same thing every single week. So I found what has worked and I'm scaling what's working. I'm not getting distracted with other business ventures, and I'm not even getting distracted with other business ventures within real estate. Even the other businesses that I've started, they're all 1 degree from what I'm already a master at. Yeah. So I'm a master at real estate investing. It made sense to start a construction company because I am my number 1 customer for that construction company. Made sense to start a management company. Same logic there. Made sense to start an education company. I'm already doing this. Why not teach other people how to do it? So I didn't have to reinvent the wheel for any of these businesses, and I've stayed in my lane. So yeah, I would say, if you do those 4 things and you stick with it, success is inevitable.
So let me ask you this. At what point, because I remember the point when I did it, and I remember what triggered it, at what point did you go from 1 to 4 units, like buying properties that are 1 to 4 to 5+ units, meaning like more of that apartment complex style buildings? And why did you make that pivot?
I always wanted to get into apartment buildings. The first one that I bought was a 17 unit. And frankly, it was just the first opportunity that presented itself to me. So up until that point, I had been buying, a single family, another single family, and then a couple of duplexes. And then, when the 17 unit apartment complex presented itself, I just jumped on it. So apartment buildings are great. You can obviously scale to more units and more net worth a lot faster. But I would say my best ROIs in my portfolio are actually from my single family homes. Tenants pay all the utilities, tenants mow their own grass. Turnover and vacancy is significantly lower, which is your number 1 expense as a real estate investor. So to this day, with 430 units, I am still buying single family homes. And in a weird way, those are some of my favorite assets to buy because, from an ROI perspective, they do better than anything else that I own. But on the same token, with my apartment complexes, if I BRRRR an apartment complex, I could have $1 million worth of equity in one deal. I can't do that with a single family home. So I think both are healthy, right? I'm always looking for those larger apartment deals, but sort of in between those deals, I'm still looking for those single families and those duplexes and those small multis.
It's funny. The same thing happened to me where I own the single families, and those are some of my highest ROI properties.
Yes.
And they're on fixed debt for a really long time. But I look back at how long I've owned those versus the apartment complex, and I have so much more equity in the apartment complex just because it's a much bigger deal. Not only that, but when rents went up across the board, $200-300 in my market, 25 units times 300 was a much more significant difference than $300 on a single family residence, you know? Here's what I was going to ask you. You talked about a 12 unit building that almost caused you to go bankrupt at some point.
Mm.
Tell us about that. I want to hear that story.
That's the 17 unit.
Oh, the
So the first
17, the
17
first
unit
one,
that
really?
the first one, yeah. Because I dived into this like a year into real estate investing.
Yeah.
I didn't know what I was doing.
Yeah.
So I put a lot of trust into my property manager. I put a lot of trust into my contractor. And just like any operation that's mismanaged, I had a $80,000 budget for 17 units, just to give you reference of what,
Yeah,
how
it's like
little I knew.
$4,000 per unit, basically.
Yeah, I had no money. So, needless to say, I ran out very, very quick. And I didn't even get $80,000 worth of work because I wasn't managing construction properly. And I'm like 23 years old at the time with no money in a 17 unit apartment complex that I didn't know what to do with because I didn't have any money and I didn't have any experience. So that is what forced me to really kick into gear. So when I tell people I've put blood, sweat, and tears into this business, a lot of the tears came from that property, just from the stress, just from like, I can't do this anymore. But that 17 unit is what forced me. I had to get a couple serving jobs on nights and weekends to make some more money. I had to physically go to this property and paint and lay flooring and install cabinets. My best friend was helping me. My dad was helping me. Like I was just getting all the help I could possibly get just to bring this to the finish line. And then, 2 years later, it still really wasn't stabilized. It was still upside down. And so what I was eventually able to do was I was able to partner with a nonprofit here in St. Louis that specializes in affordable housing. So I was able to structure a JV deal, which at that point I had had a lot of experience negotiating JV partnerships, where the nonprofit puts up all of the money for this deal. They rehab it, they manage it, they do absolutely everything. And I just give them 50% equity in this apartment complex. So I essentially sold them 50% equity in exchange for them, rehabbing this apartment complex and sort of bringing it to life. So I learned, what not to do from that building, but it ended up being a massive success.
Well, not only that, but I think it stretched you in a sense where it forced you to get really uncomfortable. It's the same thing that happened to me with my 25 unit building. I had a contractor stealing from me. I went way over budget. It happened during COVID. It was just so many things, but it elevated me to a different level where it forced me to become a better operator, to learn it. And now after that, it's funny because when I bought that building, that was a $4 million building. Then I bought like an 11 unit not too long after, and pulling the trigger on the 11 unit was so much easier than pulling the trigger on the 25 unit. The 25 unit actually created anxiety for me at that present moment when buying it. So it kind of stretched out what was possible, basically.
To this day, I think I am as good as I am at operations
Because of
because
that.
of that building.
Yeah.
And because, I mean, unfortunately, I had that 17 unit and I had like 8 other projects that also weren't going well. So like
What
every
year was
day it
this?
was like, huh?
What year was this?
This had to be like 2019.
Okay, not too long
Yeah,
ago.
something like that.
Right before
2019
COVID
ish.
too. Yeah,
Yeah, before COVID, which I got my crap together right before COVID, which was good because I bought a bunch of properties and then I was able to ride that appreciation
appreciation.
train, which was nice. But I truly believe, or not even believe, I know that the reason why I'm good at construction management and property management and real estate investing as a whole is because I went through that crap and I
Yeah.
fought through it.
So let's talk about like JV versus syndication. So, or even doing it independently, meaning like buying units independently versus a JV versus a syndication. Talk to us about the three different options that people have when buying rental properties.
So the reason why we all invest in real estate is for cash flow and equity. That's why we do this. And then if you're mega wealthy, it's for tax benefits, right? But that's why we get into real estate. So it's not about owning as many units as humanly possible. It's about increasing your net worth through real estate, producing cash flow, and not paying taxes on that cash flow. That's essentially why we get into this business. So I'll start with doing it all yourself. So I own 430 units roughly. The question that I need to ask myself, because I own exactly 51% of my entire portfolio. So would I have been able to get to 215 units all 100% by myself? And the answer is 100% no. I didn't have enough money to do that, because even if you do the BRRRR deal, even if you do the BRRRR method, creative finance, even if you do all these things, there is some money that's going to come out of pocket unless you're buying like slam dunk deals every single time. And you're not going to be able to scale quickly if you're only buying slam dunk deals every time.
Yeah.
So I wouldn't have been able to get to 215 units on my own. Not a chance. I maybe would be at 100 units at this point if I did that, right? So doing it all by yourself, that's awful. Now, syndications. With your standard syndication, you have a GP LP split. Standard split for that, you have your limited partners who are the passive investors, and then you have the general partners who are the subject matter experts and the operators. You might have an 80-20 split or a 70-30 split or something in between for the GPs and LPs. So if you have a 70-30 split, 70 for the LPs and 30 for the GPs, if you have a 100 unit apartment complex, which is a lot of units, on average, you're going to have probably 3 GPs. You might even have more than that. And so if you have 3 GPs that are splitting 30%, your equity percentage in that deal as a GP is 10%. So you now own 10% of a 100 unit apartment complex. Well, you could have just bought a 10 unit by yourself, or you could have JV'd on a 20 unit, and you would have accomplished the exact same thing from a net worth and cash flow perspective. The only thing that you miss out on is you don't get to brag about the fact that you own thousands of units, right? So I've kind of taken the step in between both of those, where I've met a lot of people who want to get into real estate investing. I'm the subject matter expert. I find the deal. I raise the money for that deal from the private money lender, the hard money lender, or the commercial bank if it's an apartment complex. I do all of the operations, so the construction management. I basically go A to Z, full cycle that deal and making it a success. From a distressed property to a refinance property that everyone's making money, and everyone has equity and everyone's cash flowing. And all they have to do in exchange for that is put up the money. So what I've done is I've done a lot of JV partnerships where I do the work, they put up the money, we split the deal 50-50. And I think until I find a more efficient or better route, this makes the most sense, where I'm still getting a large amount of equity and a large amount of cash flow in all of these deals, but I'm also not limited by the amount of cash that I have. I can still scale, and I still one day will have thousands of units, but I'm going to have a much larger equity stake in that portfolio.
Yeah, it allows you to scale faster too, because for you to come up with the money that you would need for the down payments, the rehabs, and all that, it would be a lot more challenging without the JV structures. So let me ask you this:
Right.
like, um, I've somewhat been hesitant to do JV structures,
Mm.
and the logic behind that was just like selecting the right partners. Basically, it essentially is a partner in the
Yeah.
JV structures. Do they have an active say of when the property gets sold as well too? And then if so, what do you look for in JV partners? And have you found like certain types of people, like business owners, doctors, attorneys, make better JV partners than others?
So, to answer that question first, anyone who is interested in real estate but doesn't have the time or the know how to do it themselves.
Love
So,
it.
I don't have to go through, I don't have to pitch them on real estate. I don't have to sell them on anything. These are all people who want to get into real estate, but they don't have the know how or the expertise. So, that's first of all, those are the types of people that I'm looking for. In terms of voting rights, they have the exact same voting rights that I do. So this is not, that is one of the advantages of a syndication. If you have a GPLP structure, the limited partners have zero voting rights. So when you're JVing with someone, to your point, you have to make sure that this is someone that you want to go to bed with, right? And so JVs, I mean, a lot like
I'm
marriages,
sorry, I didn't understand the analogy of going to bed. I'm just kidding.
make sure it's someone that you definitely want to partner with, right? Um, because JVs, very much like marriages, they're very easy to get into and very difficult to get out of, right? So, I mean, all of these partnerships that I have, I'm very upfront about, what I want out of it. They're talking about what they want. We make sure that we align. Also, with all of these partnerships, although it's not officially a GP/LP structure, it is very obvious that I am the subject matter expert and they obviously trust me. So, although it's not officially a GP/LP structure, I am still vast majority, having the say in how things go. Right. And then I'm very fortunate that if any of my partners, and I've had this happen, I've had partners who want to sell a property and I don't want to sell because they're in a different financial place. I'm in a place financially and in business now where if they want to sell, it's like, okay, let's sell. No big deal. I'll just take my proceeds and I'll go do something else with it. So that's what I would say. You got to be you're exactly right. They have the voting rights. You got to be very slow to get into the partnerships. You got to make sure that these are people that you align with long term. And for me, if they ever made a decision about selling or something like that, personally, I'm totally fine with that. If you're not totally fine with that, then perhaps it's not the strategy for you.
Got it. Okay, cool. And then let me ask you this: like, why the GP or JV structure versus just offering them like a debt return on their money? Like means like saying, hey, look, like if you become the debt partner, I'm getting a good deal on it. I'll pay you 12%. You get 12% return on your money. Why that structure and owning 100% of it versus the JV structure?
So there's the debt structure and there's the equity structure. So the debt structure is less advantageous short term and more advantageous long term. The equity structure is more advantageous short term and less advantageous long term. So I've done the debt structure when I first got started. And I noticed that because I was limited by the amount of income that I had, I couldn't make the deal work and pay interest
On the
to
money.
a debt partner.
Yeah.
So I was basically 100% leveraged with a debt partner.
Yeah.
So for me, I would rather get there faster. There's a lot less risk with the
Yeah.
JV partnership. There is less reward, but also if a roof needs to be replaced, we're splitting that 50-50. So also my liability has also been cut in half. So there's nothing wrong with a debt structure. I used to do that all the time. But for me and just peace of mind and not wanting to come out of pocket a bunch of money every single deal, the JV structure is just more streamlined. It gets me to where I want to go faster.
Yeah, and as long as you have the right partners, it basically works out. Basically, so basically anybody that has an interest in real estate. Now, let me ask you this: have any of your JV structures gone sideways? Meaning, like, hey, look, like they went through a divorce, and because they went through a divorce, they needed to sell a property, or like became a different person, or certain red flags, like almost like a marriage. Like sometimes people get married, they basically thought they were in love, and then they realize, like, oh man, like this is something that I should have picked up on, or certain red flags. Or in other words, like are there certain red flags that you'd be like, hey, look, I'd avoid this 100%, and certain things that are like, I guess, green flags?
So not yet. I have not had a partnership go sideways in the sense that we disagree and, one of us becomes a different person and it turns into a legal issue. Not even close, as a matter of fact. I am actually quite close with all of my partners.
Amazing.
Some of them are people I went to college with. Some of them are people that I've known in the real estate business for a long time. Some of them are mentees of mine that I talk with every single week. So I know my partners very, very well. Now, I've had plenty of times where my partner wants to sell an asset and I might not necessarily want to sell it. But like I said earlier, that's easy. It's like, you want to sell, you need money, fine, let's sell, no problem. So I have had partnerships where we disagree on if we want to sell or keep an asset, and that's been a pretty easy resolution. But I have not had a partnership that has gone south.
I love it. Walk us through your best deal that you've ever had.
I'm gonna say, there's a couple that come to mind. I recently closed on a 36 unit. I bought it for $4.5 million. We're going to put roughly $300,000 into it, and we have an as completed appraisal for $6.5 million. Partly because we're converting a lot of the one beds into two beds, so that rent's going to increase quite a bit. So a lot of equity in that one. That's got to be one of my best. I own a 28 unit here in Soulard. We bought for 2.8 or 2.85. We put $300,000 into it, and we just listed it on the market yesterday for $4.75 million. So that one was pretty damn good. What's that? $1.5 million in equity. And I have a couple more examples like that. So I'd say the common theme amongst the best deals are, they're value add apartment complexes that I've been able to really quantum leap my net worth quite a bit. And then I have several examples like that for smaller deals. So I own a 4-unit that has an ADU in the back, and that property appraised for $400,000. But we ran the numbers at $220,000, so we had $180,000 more equity than what we thought. So I have a lot of examples of really good deals. I think what makes that possible is when I'm buying these deals, I do run the numbers very conservatively. So I am running my ARV. If I think I can get 250, I might buy it at 220, for example. And then, if the appraiser shortchanges me, I still have the ARV that I need. So I have that exact same philosophy with everything that I buy.
Got it. Now, you said that an investor's job earlier is like deals and money. Walk us through how you're getting some of these deals. Are they on market? Are they off market? Are they through wholesalers? What does that look like?
Yep. So 90% of my deals today are from the market and my relationships. So the MLS and my relationships. And when I say relationships, I'm referring to wholesalers, investor-friendly agents, other investors who are trying to offload their portfolio. So those relationships have been key for me. And then also in St. Louis, I think a lot of people underestimate how much opportunity there is on the MLS in St. Louis. Because St. Louis, just certain parts of it, there's just a ton of opportunity. These parts of town just simply need more investment. So that's been huge for me. And then I would say the other 10% is from creative strategies, maybe Facebook Marketplace, calling a for rent sign, Craigslist, like how I found my first deal, some direct to seller strategies, things like that. But 90% is the market and relationships.
Have interest rates going up affected the business model in any way, shape, or form? Meaning, or do you see any future um, effects? Meaning, like for the properties that you bought in 2019, I'm imagining that you've got like a 7-year fix or a 10-year fix, like most commercial at 3 point something percent. That'll eventually come due, meaning that at some point it'll come due and then rates will be whatever they are at that time. What impact have you seen in the marketplace uh, for other investors and for the portfolio as well too?
So real estate's a local sport, so I can speak to my portfolio here in St. Louis. The market has certainly slowed down. So for my flips, I'm noticing that those properties have longer days on market. For my rentals, it has had virtually no effect. And the reason for that is because, in real estate investing, we have linear markets and then we have more cyclical markets. So if you look at a market like California, New York, certain parts of Texas, Florida, you can get massive appreciation in certain parts of those times, but then you could also get some corrections in those markets, right? Especially with apartment deals as interest rates go up. If you're looking at a multi-million-dollar apartment complex, you can start to get, lower demand, and thus those prices can start to go down. When you're dealing with a linear market like St. Louis or Cleveland, Ohio, or Detroit, Michigan, or those affordable markets, if you have a $150,000 house, that $150,000 house ain't gonna go to $75,000. It can't happen. It's already too affordable.
Yeah.
And so now, while we don't see, there were some markets in Florida during the COVID era that you saw like 30% appreciation in 1 year. We did not experience that, but we also don't experience, the massive corrections either. It's a very boring 3 to 5% appreciation every single year. So we do get a little bit less of the upside, but we also get a lot less of the risk as well.
Yeah.
And then the other cool thing about real estate investing, if you're a long-term buy and hold investor, you're kind of always winning, because if interest rates come down, demand and gunpowder increases, and so asset prices go up. If interest rates go up, demand and gunpowder goes down, and you only have 3 options, right? You can buy a home, you can rent a home, or you can be homeless. So if you can't buy a home, you got to rent a home. And so demand for my rental properties increases. And so my rental prices go up. And so with me buying below the median in a linear market and thinking about, with my plan being holding on to these for the next 30 years, my philosophy really doesn't change at all for my rental properties. But for my flips, like I said, the market's a little bit slower. So perhaps I buy a few less flips, or I buy them that much more conservatively.
Got it. What about the interest rate? What's the game plan when the rates come due or when the loan comes due?
The vast majority of my loans are DSCR loans. So those are 30-year fixed.
Amazing.
Mm-hmm. With my commercial loans, I bought a lot of those after the COVID era. So the deal already penciled out at a 7.5% rate. I didn't buy these at a 4% interest rate. So the majority of my commercial loans already pencil out at that 7.5% rate. And then for my 1 to 4 units, the majority of those are in DSCR 30-year fixed rate debt.
What do the numbers look? So I know you went through an apartment building that you bought for 4.5 million. You're going to do 300, and then it'll be worth 6.5. What would something like that bring in rents per year approximately?
Oh, I don't know off the top of my head. So 36 units, one beds are going to go for about 1,300. Two beds are going to go for about 15 to 1,600. And so whatever the math is on that. So of that 36 units, there's a 12 unit and a 24 unit. In the 24 unit, we're going to convert 22 of the 24 one beds into two beds. So we'll have 14 one beds and we'll have 22 two beds.
Do
So if
you
you do
look
the math, whatever
do,
that is.
do you do like, I know back in the day there was like a 1.1% rule or whatever. Do you follow any of those rules, or is there like a certain amount of cash flow that you look for after you buy a deal, like a 1.25 DCR or one and a
Yep.
half, or what do you typically look for?
So there's a few things that I look for. So I'm looking to, first of all, I'm looking to BRRRR every single one of these deals. So whether it's an apartment complex or a 1 to 4 unit, I'm trying to buy it at 75% of ARV. So that's number one. If it doesn't meet that criteria, I won't even look at it. Cash flow, I look for $150 per unit. That's my minimum criteria. If it's like 130, I'll still do it, but if it's below 100, I won't give it a second look. Debt service coverage ratio in most instances. So for a 1 to 4 unit, I need that to be a 1.20. If it is a larger apartment complex, I need it to be 1.25 so that it qualifies for agency debt. So when I go and refinance, I could get fixed rate debt for a long time. And those are really the main criteria. That's what I look for. So if the cash flow meets my criteria, I could buy it at 75% of ARV, and it meets the DSCR requirement that an agency, broker, or a commercial lender is going to underwrite it at. And if I like the location, then it's a deal for me.
I think one of your gifts is probably the operations, especially coming in from like an engineering background. Walk us through, you buy the building. How do you, what does that process look like from I bought a failing business basically to making it a successful business?
So today it's pretty streamlined and simple. Back in the day, it wasn't. But I'm getting that deal under contract. I'm lining up the private money lender, the hard money lender to purchase it. And then I'm getting checkout construction to do the work. We have a project manager now who kind of oversees the work for me. And the beautiful thing about it is, like I said earlier, if you see one of my properties, you know that it's one of my properties, right? It has the exact same paint, the exact same flooring, the same kitchen, the same bath, right? Absolutely everything is the same. So I don't need to tell my crew, like, hey, let's do this to this property. Let's do this kind of paint. Let's do this layout. Like, it's already systematized. They already know what they're doing. So I put the address in our system and they just go. So as far as I'm concerned, like, my process is pretty streamlined, and then I'm walking that job about once or twice a week.
What does it cost you per unit to renovate approximately? Or what do you factor in?
Totally depends. So if it needs MEPs as well, I mean, you could be at 40 grand a unit. If it's strictly cosmetic, it could be 15 to 20 grand a unit. If it's an apartment complex, it could be 7,500 a unit, because we're just kind of putting lipstick on a pig, and we mainly care about the income at the end of the day. So that's really all that matters. So it really depends. I would say with my average, St. Louis duplex, 20 to 30 a unit.
I love it.
My philosophy with all of my properties is, I have an obsession with keeping vacancy low, right? So I want my units to be the nicest in its part of town. So if you look at my properties in St. Louis compared to all the comps, my units are superior in terms of cosmetic appeal. They look really good. We put tile in the bathrooms. We put, 42-inch cabinets, quartz countertops. Fancy light fixtures, we really deck these out. We spend a little bit more money to make them look nice. And then we're also keeping our rents slightly below market rent as well, to keep our turnover and our vacancy low. So as a result of that system, we're finding that tenants are, first of all, filling up our units rather quickly, but they're also staying long term because they can't get a better deal anywhere else.
What are your thoughts on out-of-state investing?
I'm a fan.
Yeah.
But what I'm not a fan of, though, is if you're going to do out of state investing, like for someone in California, I would recommend that they do out of state investing because I think that the real estate's unaffordable unless you know something about California that I don't, and there's a nice submarket that you can invest in. What I'm not a fan of is diversifying every 5 units in a different part of town. The most successful investors that I know, they go very deep. They don't go wide. So they do something similar to what I'm doing now, right? All 430 of my units are in St. Louis, and I'm vertically integrated. I have my own construction company. I have my own management company. And so I'm buying a lot of properties in St. Louis, and I probably always will, honestly. Maybe when I get to, I don't know, 1,500 units, maybe I'll diversify a little bit. So I have no problem with out-of-state investing. Some of my mentees are out of state, and I teach them how to invest out of state in St. Louis. But their plan is to only invest in St. Louis. So they're going to become an expert in one market and put all their eggs in that basket.
If somebody was going outside of St. Louis, if you were going outside of St. Louis, what would you look for in a market?
Linear market. So it'd have to be an affordable market. So I would do like a Cleveland, Ohio, Detroit, Michigan. I would do a market like that. The main thing for me is cash flow. So if I'm investing in a market like New York or Washington or something like that, where asset prices are way too high, or Las Vegas, I hear podcasts all the time of people in those markets who just aren't buying right now because it doesn't make sense. Yeah. So for me, it has to be a very predictable, boring, linear market that has good cash flow. But I have to really know the market really well. So like St. Louis, I grew up here. I know all the parts of town, the streets. I've lived in St. Louis for many, many years. Like I know St. Louis really well. So
yeah. Who's your ideal student? Like, meaning, like, what does an ideal student look like for you? And then maybe a success story for a student that you've had.
Okay. Someone who's hungry, I think it is what it boils down to. Someone who, I have some students who I meet with on a weekly basis, and I ask them what they've done that week, and they say not much. And then I have other students that I hear from damn near every single day because they're doing stuff every single day. So someone that's hungry, someone that really wants success, and someone that really wants to learn is someone who's an ideal student. That's how I was when I got started. And the ones who are most successful have a ready, shoot, aim approach. They're not overly analytical where they're talking themselves out of deals because the furnace is too old, for example, or something like that, right? They very much have the numbers pencil out. I don't understand everything, but I'm going to figure it out as I go. And then for a success story, my number one student got 86 units in his first year. I have another student who got below 60. Don't quote me on the exact number, but it was like 56 or something like that. I've had several students who get, above 20. And then the goal for all of my students is to get from 0 to 10 units in their first year. And I've had several who've done that.
Got it. Amazing. Cool. Any final thoughts or anything like that you'd like to add?
I would just say if you are looking to get started in real estate, my biggest regret as an entrepreneur is not documenting the journey. I did not get heavy into social media until roughly a year ago. And the main reason for that is because, frankly, I was too insecure to start posting because so much was going wrong that I didn't want to post. And then 5 years from now, I'm bankrupt And my story is that I tried and I failed. So I didn't start posting. But then once I got financial freedom, started doing things really well, I was like, damn, I really should start posting on social media about this, because everyone I knew who was doing bigger things than me, all of them had a presence on social media. And so if I would have started documenting that journey from day one, my success would probably be double what it is today. So my singular biggest regret as an entrepreneur is not documenting that journey sooner.
Well, I want to say thank you for taking the time to come on the show. If you've enjoyed this episode, make sure to hit that subscribe button. If you feel that this episode will be helpful to somebody else, make sure to hit that share button. Thank you again. And to our viewers, until next time.